Hello, it's Jenny here to lay down the law about all the different things you need to know to be able to raise money for your business and do it legally, do it in a way that doesn't break the law, but still allows you to stay in control of your business and do things on your own terms. So what I want to share about today is thinking about what you're going to offer to investors. This is the what we call step 3 in my system for my 6-step system for designing your capital raising strategy. And it's super important because, what you offer to investors has a huge impact on the future of your business. If you offer something to investors that is just kind of an off-the-shelf type of offering, like maybe someone hands you something called a safe or a convertible note and says, here, just use this. That might not be the right fit. So I'm a huge advocate for really understanding all the different kinds of things that could be offered to investors. Sorry, I'm trying to mess with my lighting here. Anyway, and choose the one that's best for you. So one of the big choices that you'll want to make when designing your offering to investors is whether you want to offer equity or debt. There is kind of a third category, which is something that's convertible from one to the other, like a convertible note. Is usually a convertible from debt to equity later. A safe is something that's just a piece of paper that might be convertible into equity later. But it's really, even if you're using a convertible instrument, at the time you offer it, it has to be considered either equity or debt. From an accounting perspective, if you raise money from an investor, it has to be either equity or debt. Otherwise, your accountant won't know what to do with it, and the IRS won't know how to treat it. So it's really important. One of the very first decisions that you should make is it better for me to offer equity or debt? And I know that a lot of people, when they think about offering investments to, raising money from investors for your business, they don't really think about debt. Like, they kind of assume if I'm raising money from investors, I must be offering equity. Someone must be buying a piece of my business, because debt is something you get from a bank. But that's not true, because you actually can offer a debt instrument to investors. And unlike what you would get from a bank, it tends to be a lot more flexible. I mean, it's up to you to design it. So for example, you don't have to have collateral. You could set it up so that you only have to make annual payments instead of monthly payments. You don't have to have personal guarantees. So debt can be a really great thing to offer to investors. It's very different from what you would get from a bank. But there are still some things that you need to think about before choosing to offer debt. So I'm going to just talk a little bit about some of the pros and cons of debt. So the thing about debt is you're basically making an agreement with your investors to pay them back a certain amount of money over time. And there's interest on top of the amount that you've borrowed. So, there's the principal, which is the amount you borrow, and then there's the interest, which is whatever you pay on top of that. And the IRS is going to expect you to pay interest. A zero interest loan isn't really a good thing to do because there can be some problems in terms of tax treatment. So, but how you pay the interest and how long you take to pay it back is, you have a lot of flexibility there. So that's really nice. But the thing about debt is it is a liability. So when you look at your balance sheet, it's going to show up as a liability on your book. So it's going to make your business look a little bit less good from a balance sheet perspective, because, when you owe money, that's not always looked at as like a really positive thing on your balance sheet. So you don't want to have a balance sheet that has a huge amount of debt on it and not a lot of equity. Equity is just money that you've invested into the business that doesn't have to be paid back. So that's one thing that's kind of bad about debt. However, that isn't necessarily the worst thing in the world. If you borrow debt and you have a good pathway to paying it back, having a liability on your balance sheet for a certain period of time isn't the worst thing in the world. Unless, of course, you think you're going to need to borrow money from a bank, then they might not look kindly on that. So that's one thing. The other thing is that with debt, I think this is probably the biggest reason why you maybe wouldn't want to raise money in the form of debt, and that is that you really have to start paying it back, I'd say within about a year. Because if you set up a debt offering where you don't make any payments for several years, it could be recharacterized by the IRS, and the IRS could say that isn't really debt. One of the characteristics of debt is you start paying it back fairly soon after you borrow it. So if your business is one, and this is super common, there's lots of businesses where maybe you're just starting out and you have a lot of work to do before you start generating positive cash flow. If that's the case, debt is not going to be a good fit for you. You need to have positive cash flow that you expect to be coming in within, the next year or so you can start paying it back. It doesn't have to be a huge payment. It could be like an interest-only payment of 3% or something like that. But you do have to start paying it back, fairly soon. You don't want to leave that for many years because it could cause problems from a tax perspective. So if you have a business that's going to take a long time to break even, debt's probably not going to be a good choice. Some good things about debt are that it is quite simple to document. So usually, I definitely feel like whatever you're offering, you want to have a lawyer involved. But if you're offering debt, it's going to tend to be possibly a bit cheaper because it's much simpler to document than equity, and the relationship is much clearer. A debt investor, it's quite clear what the relationship is, what their rights are. It's all spelled out in the document. So those are some of the things about debt to think about. Also, I keep thinking of more stuff. Also, some investors, if your investors are a little bit less sophisticated and knowledgeable about finance, often debt is going to be more appealing to them because it's going to be easier for them to understand. So what about equity? So equity is generally speaking an ownership interest in your company. So you do have to have some kind of an entity if you're offering equity. It has, an LLC or a corporation. And so you just sell a piece of the company, whatever type of entity it is, to your investors. One thing that's tricky about that is when you sell equity, you have to figure out how to price it. It's very kind of arbitrary. So for example, let's say I decided I really want to raise $500,000 from investors, and I have a corporation and I know I want to raise $500,000. What percentage of the ownership of my corporation am I willing to sell for $500,000? Maybe it's 10%, maybe it's 20%, maybe it's 70%, who knows? I have to make that decision. And I also have to be able to make a good argument as to why I feel that that's the amount that I should be selling for the amount I'm raising. I think sometimes it's not that important because the way you're compensating your investors might have nothing to do with the value of the equity you're selling, but still you do have to choose a value, and sometimes that can be kind of challenging because it's quite an arbitrary decision, especially if you're a newer company. There really is no objective way to value a company. The value of the company is really, and it's not even really the value of the company, it's the value of the particular equity that you're selling. So it's the particular package of rights that your investors will get, like maybe a preference for receiving shares of your profits, or if you sell the company, a preference to get paid back first or something like that. So you're putting together a package of economic and governance rights that you're selling to your investors in the form of an equity interest in your company, and you have to come up with a price on that. So, and there's really no objective way to determine what that price is. So that can be a little hard, but if you're willing to just accept the fact that you need to just pick a price and be willing to stand by it, that's not a big deal. Equity is a little more complicated to document. It means you're going to have to amend the governing documents of your business, unlike with debt where it's just like a fairly simple document that you'd be using. So it can be a little more expensive to use. Also, it does tend to be kind of a more long-term relationship that you're establishing with your investors, because with debt, there's really a clear pathway for them to exit. You know, they're going to get paid back over a period of time, and once they're paid back with interest, they're out. You know, it's very clear from the beginning what it's going to take for them to no longer be an investor in your business. Whereas with equity, that's a lot less clear, because often with equity, there really is no requirement to pay your investors back at all, which could actually be a nice thing, right? I mean, that is probably one of the best things about equity, is that unlike debt, you don't have to be worried like, oh my God, I have to start paying it back right away. Equity is inherently designed to be more patient capital, where maybe you can't make any payments for like 5 or 10 years. You know, that's totally fine. One of my clients, a community foods market in Oakland, you know, they haven't made any payments yet. They raised money in the form of equity, gosh, almost 10 years ago. But they're up and running, and so hopefully they'll start making payments soon. So that's a great thing about equity. But a little bit of a negative aspect of that is you may have a longer term relationship with the investors where there's not a lot of clarity about how will they eventually get out, if ever. Maybe they'll never get out. Maybe they'll be part of your company forever, like for the next, you know, when your grandkids are running your company and you're dead, they might still be part of your company. So, and which can be a good thing, but can be a bad thing too, because sometimes you and your investors might want a little more clarity around that. But the cool thing about equity is you can design some things that we call structured exits. There's a few different ways to do that, where you can actually get a little more clear on how an exit might happen. And there, again, I don't want to get into the details. I've talked about some of the models for that in some of my other videos, but equity doesn't have to be forever. You can design strategies where they will eventually exit, maybe over time, or maybe when a certain milestone is reached. But it's certainly not nearly as clear and defined, you know, when that will happen and how that will happen. So I think those are really kind of the main points I wanted to make about equity versus debt. But I think, so, you know, number one is to choose which one you want. But that's really just the very beginning of the decision-making process, because once you choose equity versus debt, then you have to figure out what are the details, because within those two, there's an infinite number of ways that it can be structured. So, but you'll be well on your way to designing a great offering for you if you can choose between the two. Sometimes people ask me, what if I want to do both? And that's actually fine. You know, if you think you would like to offer both, like for example, sometimes people will say, you know, if someone's willing to invest at least $50,000, I would give them equity. But if I'm willing to accept lower investment amounts, but in that case, I want it to be debt. You know, that's just an example of how you might choose to offer both for different investment amounts. Or there might be there might be someone that you really want to have as a long-term, you know, owner of the business, and you'd offer them equity, but other people you don't want that, so you'd offer them debt. So you can do both as part of the same offering. Of course, it will probably add to the expense because you have to have your lawyer drafting both. But it is certainly possible. You don't necessarily have to choose. You could do both. So I'm going to stop there, but feel free, if you have questions about the choice between equity and debt, feel free to put them in the comment section below. If you want to get on our newsletter list, if you're not getting our newsletters, just go to jennykassan.com. You also get a free report on things that you can do to prepare to have a really great conversation with potential investors. So all kinds of great resources if you sign up on our email list, and you will get a monthly newsletter that always has amazing, helpful information in it. All right, I look forward to seeing you next week. Bye.